don't mind. And Tom, I'm going to put it over to you.
Sue. Thank you. And again, a huge shout out to Sue for always making sure we all have these in our inbox and getting these set up. So Sue, thank you for putting these level ups together. Thank you. So I'm gonna switch the order around a little bit, simply because I'd like to go scary to negative to positive. Okay. So first thing I want to hit on is kind of the elephant in the room. And when this lawsuit was handed down here, just a few days ago, it started just a barrage of phone calls to me asking me how this was going to impact everything. Okay. So for those of you who don't know, back in 2019, there was a lawsuit against several real estate companies. And the lawsuit was arguing that there was basically collusion in pricing. So that real estate companies were colluding with one another to fix pricing for real estate commissions. Okay. Now, anybody who's studied economics, and my degree is accounting, economics, and finance, will recognize that the term collusion is not a positive thing. Okay. So collusion is where we all get together and say, hey, we're going to set the price, and as long as everybody agrees to it, then we can kind of keep the price level, and that means there's no commission. So 2019, there was a lawsuit. We ended up seeing several of the large real estate companies wrote significant checks. But what ended up happening out of that is those same attorneys decided to turn this into a class action that was filed in the state of Missouri on behalf of 60,000 homeowners. And that jury awarded a verdict of about $1.7 to $1.8 billion to the plaintiffs on Tuesday. Okay. So what that means is basically a jury of our peers sided with the plaintiffs and said that the real estate agents and the real estate companies had colluded to fix prices, is basically what occurred. Their argument was that the MLS, the NAR, all the real estate offices had all come together and set your real estate prices, and thus that was artificially keeping real estate values increasing, and at the same time it was reducing negotiation abilities on behalf of the buyer. Okay. Obviously, this is being appealed. Everybody's trying to say, hey, this is not right, this isn't correct. The attorneys, on the other hand, have said, hey, this worked in Missouri. We're going to go ahead and name more real estate offices, and we're going to start going into more states. So, my little bit of literary freedom, if you will, I think over the next several months, you're going to start seeing advertisements on TV that say, have you bought or sold a home in the last 5 years? If so, you've been defrauded, contact us, we can get you some money. That's where I think this is going. What that means is you're going to have to see NAR, you're going to have to see all your real estate brokerages, you're going to have to see TREC. Everybody's going to get out in front of this, I believe, sooner than later. Okay. So here's the basic issue that's occurring. If you think about this now, you have a listing signed with a seller. The listing agreement says that the seller is paying the commission to the buyer's agent and the seller's agent. If you're getting a buyer's rep signed with your buyer, which I don't know how many of you are on this call, but I will tell you that that is an absolute must if you're not getting it done. But if you are getting a buyer's agent rep signed now, it lists the buyer's agent commission, and then it also mentions that if the seller doesn't pay that commission, the buyer is responsible for that fee. Okay. What is going to happen moving forward is this is going to become much more of a topic of negotiation between you and your seller and you and your buyer. Okay. Now, the reason that's important is, I've been doing this for 25 or 30 years. If I've heard this once, I've heard it 100 times, where a buyer's agent has told a buyer, you do not pay my commission. The seller pays my commission. So when the buyer comes in and says, okay, is it negotiable? The short answer has always been, well, no, because you're not even paying it. Okay. the vernacular is going to have to change, because what's occurring is that now the buyer literally will be responsible for the commission, and it will be a negotiating point between the agent and the buyer and the seller and the listing agent. Okay. So what does that all mean? Well, number one, it means there's going to have to be, let me back up. I'm reading a book right now, just finished it actually, from Elon Musk. And somebody asked Elon Musk, they said, how in the world have you dealt with all of these major problems you've had at SpaceX and Tesla and the Boring Company, and I mean everyone he's started, and every company he's started has been a company that was literally creating its own market, going into a whole new space. And they said, how do you deal with all the problems that come with being in these new markets and this new space? And he said, that's very easy. He says, I don't look at everything. He says, I don't look at any problem as a problem. I reframe every problem as an opportunity. And so what I'm hearing a lot is I'm hearing a lot of people say, hey, this isn't going to be a big deal. It's not a problem. It's not, it'll all work out, etc. And what I'm going to encourage you is to not do that, to recognize that this is going to be an issue. It is an issue today. It's all over the news, which means if your buyers and sellers aren't talking to you about it, they will start talking to you about it. And reframe this problem as a really, really good opportunity. And so what is that opportunity? Well, that opportunity, I believe, is an opportunity for us as professionals to demonstrate our value at a level and a degree we've never had to do. So in lending, and I think this is really, really important. In lending back in 2006, you may or may not know, there was a little bit of an issue in our industry, okay? i.e. it completely imploded, okay? And what was occurring at that time was almost no transparency between the lender and the buyer. And you would have buyers show up at closing and they wouldn't know how much money they needed to bring to closing, and they'd show up and there'd be all these fees attached to their loan, and there'd be all these, loan modification issues and, prepayment penalties. All these things would be attached to their mortgage loan, and they would discover it at closing. And quite frankly, they either had a choice to not close and not get their house, or close and be frustrated about the situation. And so when the whole world crashed, the government came in and said, we've got to create more transparency. And that's why you now have the 3 days before you can close after getting a closing disclosure. You have 7 days after you get a loan estimate. There's all kinds of different disclosures that have been created to make sure that the buyer understands the terms that they're signing for, okay? So where that would manifest itself with the real estate commission is when the buyer shows up and says, hey, what's this commission that's being paid to you? That's going to become something of the past. That's going to have to be addressed before we get to closing, okay? There's going to have to be more transparency. Well, when that occurs, you're going to have to warrant and justify your value. And I was talking with Stephen here just a couple of days ago, and we were talking about what kind of value can you demonstrate, and honestly, can you justify it for the amount of the commission that you're charging? And so, we'll be doing classes over the next several weeks as we're getting into training, and Sue will talk about those training classes that we're doing as well. But our goal is going to be to help you demonstrate the value that you're bringing to the buyer and to the seller. And I think very, very importantly, we need to recognize that this is not value, i.e. I put you in my car and I go open doors. You're going to have value that's going to be much, much more defined for the commissions that you're charging, okay? All that to be said, there's all kinds of activity. I'm reading right now this morning that these attorneys have already gone after several other states this morning. I think this is going to become a huge topic over the next several days, and I think you'll start seeing changes in our documents and our forms probably as early as next year. So Any questions on that? I mean, obviously we don't have all the details, but any questions or thoughts on that before we hop into the war and the impact that that's having in our economy?
Have you guys been hearing about this yet? Has your clients reached out to you and said, hey, what's going on with this yet? Or have you just kind of been floating along, as it were, just business as usual?
There's been a lot of talk on the real estate side that, the realtors have been talking about it for quite a while. I haven't really heard anything from a client standpoint, other than the fact that we talk about it, that especially with our listings, that this is the way we do things now, that there's a lawsuit that's pending, and that could change the way that we do things. But as of right now, this is what we're doing. So.
Mm-hmm.
I was talking to one of my top agents yesterday about it, and he said that what everybody's going to do is they're just going to add it into the sales price, add the buyer commission into the sales price to get around it.
Yeah. So if you think about that, Jason, again, I think I get that comment. What I want to make sure everybody is very aware of is transparency is the key here. So disclosure, making sure that your buyers understand what they're paying is going to be a big deal. So for example, right now, a buyer comes in, you show them homes, you say, hey, great, this is what's going on. They get the closing, they see their commission, they don't worry about it. It's a closed deal. What's going to happen now, I believe, is you'll show a listing, and let's say it's a $500,000 listing, and you're going to say, okay, my fee is $15,000, so I'm going to go ahead and raise the price from $500 to $515. That conversation is vastly different than, hey, we're buying this for $500 and I'm getting $15,000. Does that make sense?
Yeah.
Well, not to mention the fact,
and it may not appraise. It may not appraise at that point if you do raise the price.
So here's the thought, and this is something that's been fascinating for us as a industry, because we again have had to deal with this. As we have gone through this redisclosure and this disclosure process, I have discovered that buyers are very, very, very savvy and like to negotiate. And so they'll negotiate on a $395 processing fee. And what I want everybody on this call to hear is that once buyers recognize that this is a negotiable fee, it will be something that they're going to negotiate. And so if you're not prepared to say, hey, this is the value that I provide for that fee, you're going to have some difficulty. Okay? It's no longer going to be something that can kind of be I hate to say pushed or pushed under the rug, but that's, I think, what's happened in a lot of same thing that was happening in lending, right? There's all kinds of things that were kind of hidden that people would discover once they got to closing, and by then it was too late. The same, I think, is going to happen with the real estate commission.
We were talking about this in a meeting the other day with some other agents, and I thought it was one of the comments was very interesting. We were talking about at the closing table and how, the different commissions are put on that CD, and how, sometimes as an agent, they would just go like, let's hurry and get through that. Now I think that's going to be an open dialogue versus, don't look too hard at that page. Let's just move on. And I'm sure some of you agents probably have felt the same way.
Yeah, you hit the nail on the head. I mean, it's hard. None of us, I mean, the reality is it's hard to justify all of our fees. I mean, if you think about, you walk in to sell your home to get a listing, you have to run a net sheet, and right on that net sheet is immediately showing the fee. You got to justify that fee. All we're doing now is going to take that to the buyer. Okay. The other thing that I do want to hit, and then we'll see if there's any other questions, but the other thing is right now in the buyer's rep agreement, it actually says that if the seller doesn't pay the commission, the buyers will pay that commission. Okay. Which that's fine. The problem is that if you've got a buyer that doesn't have an extra few dollars lying around, imagine how that conversation goes when you say, hey, you found your dream home, sellers are unwilling to pay the commission, so you need to bring 3% for my commission to the table. They call us at the lender, and Will says, okay, well, you need 5% down, you need 2.5% for closing costs, and now you need 3% for the real estate commission. That's going to be a very challenging conversation that we're all going to have, because truth be told, a lot of our clients don't have the money. So this is going to become a question. What do? We don't have the cash to close. And so what I'm encouraged, again, reframing any of these, I'm to put more of an emphasis on our value, and it's going to force us to disclose this stuff up front a lot more quickly. And I think that transparency long-term is going to help the buyer community in general. But it's going to be a little bit uncomfortable initially.
Well, has there been any talk from a lending standpoint in regards to being able to incorporate those fees into the loan process as well? Because you're right, there are a lot of the buyers that don't have that fee. The funny thing is, in all actuality, the buyer's been paying both sides forever. I mean, they that's where the money comes from. So it's a matter of semantics now. We did some research on our team because Stephanie and Chris have been in the real estate business 17 years. They went back to looked at some of their first transactions, and the buyer rep agreements then said the same thing, that it will try to get it from the seller first. If we can't, then you'll be responsible for that. So it's been around forever. I'm very surprised to see the number of real estate agents that aren't using buyer rep agreements or seller or listing agreements. It's amazing. And Real Brokerage has actually implemented another document to disclose that as well to the buyer and seller again. But it's an exact duplication of what we already have in the Texas real estate market. So, but I really think that, VA loans and FHA and all that, there really needs to be a process change in there to accommodate that piece of that, to be able to be incorporated into the loan process as well.
Yeah, James, I think you're right on. I think the question is going to be, rolling things into the loan is always a function of the appraisal. Okay. So whether we like it or not, the quote unquote 6% commission has been kind of a standard fee. Okay. I think at the core of this is that. I think at the core of this is the 6%. As long as it's kind of like the title fee, as long as everybody knows it's there, it's assumed as it's an assumed fee that everybody's paying. And so when an appraiser's doing an appraisal, well, if 95% of the appraisals or 95% of the properties have had a 6% commission in them, it's kind of a standard fee, right? It's no different than, you guys remember back in 2020 when all of a sudden the buyers started having to pay the title policy, right? That was a big deal, because all of a sudden it was like, wait a minute, this wasn't a fee that we were expecting, right? Well, I think the same thing's going to happen here. As soon as you start seeing people negotiate this fee, that's going to impact the sales price of some of these homes, which, by the way, is exactly what the lawsuit is saying, right? Their goal is to keep prices from rising as quickly as they have. And thus, I think we're going to have an issue. If it doesn't appraise, we can't roll it into the loan. Make sense? So any other thoughts? Then I'm gonna hand this over to Will to give us some good news.
Yeah, I have a quick question, if that's okay. You'll have to forgive me. I'm very, very new. I just got my license like 2 months ago. So I'm just getting started, getting off the ground. And this lawsuit is a very new topic for me that I've started seeing come up quite a bit. And I've discovered I don't really know much about it. So basically what you're saying is the outcome of this lawsuit is going to impact who pays the realtor's commission and I know it's always been typically on the seller. So what exactly is it just making it more, is it just putting more light onto the subject of who pays the commission? Or is it actually some kind of policy change saying, you know, the seller's going to pay the selling agent and the buyer's agent, or the buyer's going to pay the buyer's agent?
Yeah, Alex, that's a great question. I think the short answer is yes. So their argument is that there has not been transparency. That's the
Okay.
argument.
Okay.
So, you know, it's just kind of, and for all of us on this call, we would say, well, we've negotiated it and we've discussed it and we've disclosed it and, you know, all those things. But the reality is when the jury looked at the data, they said the vast majority of commissions are including a 6% commission. They then went to NAR, and there was all kinds of guidelines in NAR that said you had to disclose it this way if you wanted your property to be listed on the MLS. And all of it was geared towards making the fee more of a standard accepted fee. Okay.
Mhm.
That I think is what's being questioned. As soon as the buyer and the seller know that this is true, then all of a sudden you're getting people trying to negotiate. Follow me?
Okay. Yes. Yes, that makes more sense because you know,
That makes
I
sense?
was, yeah, I was just wondering because I'm like, well, it's written that way in the agreement that if the seller doesn't pay it, the buyer has to pay it. So I guess I'm just not sure why there's been so much confusion over that. But being new, I just haven't had a lot of experience. So,
And
you
I
know,
think
that's
the
probably
thing
why.
too is now with this lawsuit, sellers are gonna be a little more privy to say, well, wait a minute. You know,
Mm,
if I don't have to pay it, I don't want to pay it. So I think there's just going to be more discussion, you know, where in the past they've just assumed, well, that's the way it is. So
right. That
they'll
makes
have an
more
option.
sense.
Yeah.
And I definitely agree that it's going to be really hard for buyers to come up with that money at the closing table. I know I would not have been able to do that when we purchased our first home. So that's definitely going to be a bigger topic of discussion eventually.
Yeah, and it's going to prevent, like, example, I heard this was probably 5 years ago, but I had a real estate office that I was working in where one of the real estate agents was trying to do a flat fee listing. Okay. And he was asked to leave the brokerage because the brokerage says we're not a discount broker. Okay. Well, that by its very definition is manipulating prices. Do you follow me? So that's where I think we've got to be really cautious. We've got to be very cautious on what we say. Again, this is the reframing the problem as an opportunity. It becomes very, very important that we explain to our buyers and our sellers what it's costing them to do this transaction. It can't be a questionable situation. Okay. So for example, another thing, like on the lending side, one of the things that became a big disclosure was the discount point disclosure. Okay. So prior to 2008, you'd show up, you'd have all these fees, you wouldn't know what they are. So you get a letter that you sign at closing that says, hey, please be advised that you're paying this X% fee for the interest rate that you got. I mean, it's making it very, very clear. These are what these costs are being used for. So again, more transparency ultimately help a better educated consumer, and I think will force us to be more professional as well. Any other topics we'll hit on to Will? Will can give us good news.
%5 rates, Will?
What'd you say?
5% rates, Will?
I mean,
Yeah,
you
with
can
a
get
2-1 buy down, we can get you in a 5.
Yeah, if you want 5%, it's on the rate sheet. Just how much you want to pay for 5%.
That's right.
So I'll just piggyback on Tom. I mean, look, all of us, Mike and Tom and myself, have been through this because on January 1st, 2014, that's when our compensation changed. That's when our comp rules changed. And it took a while from the collapse in 08 and 09 to get to 2014. So I think, you know, yesterday after the lawsuit ended, within an hour, and a federal antitrust lawsuit was added, naming several defendants, 7 different companies, and an advertisement was put out that if you were represented by one of these 7 companies from 2019 to present, you can join this lawsuit. in the state of Missouri. So I think this is going to take a long time to play out. It's going to go through the appeals process, but I think it definitely will change. And that's what Tom said, is that the clarity that's in our process of itemized breakdowns of every single cost and what that cost entails. The average compensation for a loan officer in retail or broker world prior to 2014 was over 250 basis points, or 2.5%. Today, it's less than 1. So that clarity and transparency causes that change. But we're still here. Mike and Tom and I all lived through that. We worked through that. We're still here. So there's light at the end of the tunnel. It's just going to take time to get there. As a positive note, hey, first of all, I have a call on this same subject every Friday at 9 from 9:15 to 9:30, just to give you guys some data to head into the weekend for open houses, for seller presentations. So you have this data to be able to answer these questions. So if you want to be on that, just let us know. Sue can grab your email address and we'll get you out of that. It's 7 to 10 minutes just to give you guys a brief overview and data before you head into the weekend, where you guys are working more than most people are on the weekend. So this Wednesday, the Federal Reserve met, and they did not raise interest rates. They did not raise short-term interest rates. So that's a great sign. So previously, there's a job out there that these people are called future traders, and their job is to predict what's coming over the next 3 to 6 months, what's happening over the next 3 to 6 months. 60 days ago, their expectation was for the Federal Reserve to raise short-term rates in November and December, because the data that was being released warranted further increases. That data was showing the economy was still growing. So we need the economy to slow down and be stagnant as far as interest rates are concerned. So that those future traders have changed their tune. They now do not expect the Federal Reserve to raise rates in November, which they didn't, and December they're going to hold steady. The Federal Reserve president did say on Wednesday that if the data warrants, they will continue to raise. So they are carefully watching the data. So I wanted to give you guys some data points, and I'll share my screen of what Tom and Mike what we watch all day to show what's happening to mortgage rates in the economy. So the Fed's inline goal is to still have inflation at a 2% rate. That's their goal. Out of those inflation costs, real estate is 40% or 42% of inflation numbers. So it is the number one driver in overall inflation is real estate. One thing they said that was interesting is the increase in borrowing cost, meaning the short-term rate raising, has not stopped the consumer from spending money. So the average credit card balance in 2020 was $4,000. The average credit card balance today is $8,000 per credit card across the U.S. The economy is being propped up by credit cards, and that, people don't want to tighten their purse strings. They got to tighten their purse strings, right? So there's currently over $1 trillion in credit card debt right now. We surpassed that over the past 60 days. Okay, so that's a big change. The Federal Reserve also said they do not see rate cuts on the table yet. I know everyone's heard news about possible rate cuts sometime in the spring, but they don't have those on the table until the data warrants it. And we're going to go over data in just a few minutes. They also said they are no longer forecasting a full recession. So what that means is they think it's going to be a soft landing. Okay. They are making progress on inflation, and the expectation is for inflation to be in the 2s at some point next year. And what that really means is 2.9 or less from their perspective. That's what that means. It doesn't mean 2. It means 2.99 or less when they say in the 2s. And then in 2025, inflation to be below 2% in 2025. So that goes right along with the plan that we think rates will be lower late 2024 and into 2025. That's where we're going to see all these people refinance at that point in time. This Fed meeting Wednesday, was the best Fed meeting that we've had in 12 to 18 months as far as positivity for us in real estate. Not positive for anybody else that's outside of real estate, but positive for us in real estate. So I'm going to share my screen and I'm going to show you a couple things. Sue, can I share it? Can I do that? Okay, let's see here.
You should be able to.
Okay. So you can see this website is what we all subscribe to and we have to pay for, and it shows how investors are buying and selling mortgage-backed security coupons and how they're trading treasury bonds on a minute-by-minute basis. And you can see since that Fed meeting, it was so positive on Wednesday, and the data was so good that since Wednesday, right here, we have seen this improvement in the price of a mortgage-backed security. So this week alone, we've seen about 180 basis points in improvement in mortgage-backed securities. That improvement hasn't really been reflected on rate sheets yet. It should, if it holds, it'll be reflected on rate sheets on Monday or Tuesday. They're going to make those guys in the secondary pricing analyst, they've got a hedge to make sure we don't close a loan and then rates go up and then we're selling that loan for less because rates are higher when we go to sell that loan. So they're hedging pricing. So they want to make sure this holds. And what's driving this data or what's driving this movement is the positive Fed meeting on Wednesday. And today, again, this is only positive for us. It's negative for everybody else. So you have to be careful in how you talk about this, that unemployment went up. So the expectation was unemployment to come in even month over month, and unemployment raised 0.1%. The second item is non-farm payrolls. So in September, the country added 297,000 new jobs through non-farm payrolls. So the expectation this month was only to add 180, and we only added 150,000. So that's 100% decrease month over month on non-farm payrolls added to the economy or jobs. So that's negative for everybody else, positive for us. So that shows that the economy is stagnating, that it's slowing down and shrinking. And that's what the Federal Reserve is trying to do, is bring it to a standstill, which will relieve some of the supply chain issues, bring down the cost of consumer goods, bring down the wholesale prices of goods to pre-pandemic numbers. So that's their goal. I hope all that makes sense. It's I'm trying to give you a bunch of data, but I hope all that makes sense. Everyone's real quiet.
Overall, it's really good news. I mean, all those things are good news for us, right? Those are things that we have not seen in our favor for the last probably several months.
We haven't seen a improvement like this and since COVID hit, right? So the goal would be to hold this improvement, right? So if you can see the 3-month chart right here, we're still this in the beginning or late August, early summer, rates were in the low 7s, right? So we're still not back to where they were at the end of the summer, but we're making progress. Down here in the beginning of October, rates peaked well above 8.5, 8.375. So we're starting to see a little bit of improvement. We're not back there. It's not, rates aren't in the 6s, but it is a significant improvement this week, which is great news.
What is the rate today, Will?
You're going to be south of 8, but probably north of 7.5, somewhere mid to high 7s today. So, and I would expect it to improve a little bit more on Monday if it holds. Because that's all they want. That's what they don't want to do is drop rates today. Everyone lock a bunch of loans today. Rates go right back up on Monday. And then you're delivering loans to investors at below market rate, right? So today there's going to be a lot of hedging from secondary markets to make sure it holds, so mortgage companies aren't put in a tough position. where they're not able to cover their cost on the loan.
So Will, if I'm kind of reading between the tea leaves there, it sounds to me like there's still uncertainty and volatility. While it's positive news to a certain extent, there's still concern about the volatility. So we're not seeing a direct response in interest rates.
That's exactly correct. So we talked about in my other call on this morning that next week there is almost no data that's going to be released that can really impact the market except for on Thursday. On Thursday next week there is where's it at? I think it's Thursday. It is jobless claims next week on Thursday. That's the only report next week that can move the market. So when there's no data out that's driving the decision, the Federal Reserve is in the process of selling off everything they bought during COVID. So they're doing quantitative tightening instead of quantitative easing. So when there's no data, they're selling all their mortgage securities and treasury bonds. They're flooding the market. And there's no buyers. There's not enough. There's not people that are willing to pay full price. So when they dump assets, it devalues the mortgage coupon and it drives up interest rates. So expect some volatility next week just because of that purpose. There's no data coming out that's going to drive it either way. Anybody have any questions? I know it's super fun to talk about.
So give us a couple conversation talking points going into the market as we're dealing with buyers and sellers.
Yeah, I think this is what sets us apart, right? So knowing this data and being able to present it in a positive light. I always tell Tom and Mike, I'm like, if I'm a 28-year-old buying my first house and my primary news source is TikTok and Instagram, like I'm hiding in my house and not going outside. I'm afraid of everything, right? So by presenting it in a positive light, that there's light at the end of the tunnel, I think it's a great talking point. And not to get in the weeds, but there's enough here where you can educate someone and not give them too much information to confuse them. And I said on my call this morning, I think if you have first-time buyers that are on the fence, I think now is a great time, because if we go on a little downward trend in rate and we get back to the low 7s or high 6s over the next 90 days, there's seller concessions are going to be significantly less. That opportunity is going to be significantly less. And a first-time buyer, that's a great opportunity when interest rates are higher. Because I would say if there's a 6 in front of that, that's going to almost eliminate those.
So right there, that's a really great talking point for your buyers that are saying, hey, I'm waiting until prices come down, or I'm waiting until rates come down. Well, when that happens, that means your opportunity to make a negotiation and get any seller concession is going to go down as well.
Yeah, I think it makes a huge difference, especially when trying to sell the 2-1 buy down, because it's not cheap. And the 2-1 buy down is truly the seller subsidizing the buyer's mortgage payment through a seller concession, right? I mean, that's truly what it is. So if you're a first-time buyer and you can say, look, if you buy now, even though interest rates are higher, the seller for the next 24 months is going to subsidize your mortgage payment. They're going to make your mortgage, they're going to make a portion of your mortgage payment as an incentive to buy this house. So I think those options, if there's a 6 in front of that interest rate, they're significantly decreased.
Excellent.
Look, I'm like an economic nerd. So if anybody wants to talk about this anytime, I'm happy to do it. I enjoy it. So.
Well, let's hope this trend continues,
Mm-hmm.
you know, and for now at least.
Cool. Well, guys, this was great. I hope it's informative. Sue, talk real quickly about some of the training that we're going to do, just for the people that didn't hear that early on. Obviously going into 2024, based on the numbers we're seeing, 2024's numbers are going to be at or a little bit less than 2023. Okay. So all that to be said, we believe that planning for 24 is going to be really, really important. So often we have growth in our business, and that growth is simply because the market has grown. And I believe in 2024, in order to have growth in your business, you're going to have to pick up market share. So it's still possible. It's still very understandable to say, hey, I want to grow next year, but in order to do that, you're going to have to pick up market share. So we're bringing in 2 business planning clinics. And Sue, share your page real quick, if you would.
Happy to.
I would strongly advise you to, number 1, make sure these are on your calendar. And then number 2, make sure that anybody on your team has them on their calendar. The other thing that is awesome, and we're seeing a lot of agents do this already, is use these as an opportunity to reach out to your sphere of influence, your past clients, anybody you know that's a business owner, or anybody who's doing planning for next year. These are not specifically real estate related. So obviously they're going to have a real estate bent simply because it's primarily real estate agents that are going to be there and lenders. But this can be applied to attorneys, restaurant owners, vent hood cleaning companies. I don't care who it is. Use this as an opportunity to reach out to your buyers and your sellers that need planning and invite them to this. Just get us the information so that we can make sure they're on the list. Okay. And they're 2 really superstar trainers. Trey Williams, his course is actually a CE approved training course, which is just incredible. And then David Scoggins was one of the original MAPS coaches for Keller Williams. He's an incredible coach. And he actually is going to be teaching a class called the 12-week plan, which is just awesome. Okay.
Yeah, and I might point out, typically when we go to these business planning meetings, it costs money. This is something we want to bring to you guys as a value add. It's such good information. You need to be there. If you really are serious about building your business in the next year, 2 years, you've got to have professionals help. They're the ones there giving their expertise, their experience. It will be life-changing if you let it. Everybody have those dates down? Okay, thanks, James, for the thumbs up. I'm gonna stop sharing my screen. And any more questions on today? No? Okay, well, thank you guys for attending. If you do have questions, feel free to reach out to any of us. We'll get you the answers as much as we can. And we look forward to seeing you in 2 weeks. Make sure you're on the call. And for those who reached out to me privately, I've got your email addresses and I'll make sure to get those to Will so that you're on his Friday calls. Okay?
Everybody have a good week.
Make it a great week. Bye.
You too. Bye. Thank you.
Thank you.